book is called Investing Amid Low Expected Returns, and you make a very comprehensive case for low returns to most popular investment categories over the next decade or perhaps longer. And what I find fascinating is that many empiricists, including me, have been calling for low returns to especially U.S. equities and perhaps global equities and bonds for going on maybe over 10 years at least. And somehow global cap weighted indices and especially U.S. indices have delivered substantially above average returns over most of that horizon. And so, I think it's really timely for you to revisit these topics now that we've gone through this decade and many of us have sort of been a little bit on our back foot in terms of our analytical cases and our analytical models. And I'm just wondering, what happened, do you think, over the last decade that was so different and rendered the models that we were used to using and that were reliable historically just more off than usual?
Yeah. I think that's such an important question, because those high realized returns over the past decade, they make any reasonable observer wonder whether these Cassandras are like the boy who cried wolf and we shouldn't listen to them anymore. And I do think, and I do make a strong case, that this is a dangerous time to become complacent, and it's likely a wrong lesson at this point. So I do deal with it, and in the book, and actually in something we have written more recently, just as a sort of 10-year retrospective. How did these forecasts in general get it so wrong? And we can look at realized returns and see why. And S&P 500 is a really good case in point, because that's really at the heart of this strong success, even more than bonds actually. So the main answer is that rich assets got even richer. So if you think of the CAPE or Shiller price earnings ratio of S&P 500, it went in the last 10 years from mildly above average 20-ish to wildly above average 40-ish. And that kind of doubling of valuations, you can calculate how much that means prorated for every year, and it's almost 7% per year. And so that, if you could foresee that, I'm grateful that we were not calling for mean reversion like some others were, but just sort of thinking of that starting yields are a good anchor. They didn't turn out to be a good anchor when you got that type of repricing. There also was benign growth and low inflation. So I do think that it's important to head on sort of explain why the forecast was wrong, but also then if you sort of buy the argument that, okay, so that's water under the bridge, then the question is, what about now? So now the starting yields are even lower. So the picture in some sense is even bleaker. So one simple way of thinking is if this CAPE is 40, and it's not quite 40 now, but that would mean 2.5%. So 1 over 40 is the yield. So 1 over price is the yield. So 2.5% expected real return proxy. And a decade ago, it was about 5%. So that was, 20 CAPE was about 5%. So we really have got this much more challenging situation. And I think for the coming decade, we would need really more richening, another growth surprise, and actually probably disinflation to make things work and to get another positive return surprise. More likely we'll get the opposite.